Have you ever wondered how repo and reverse repo rates affect your personal finances? If so, you're in the right place. Today, we're going to break down these seemingly complex terms into something much more digestible. Let's dive right in. First up, let's talk about repo rates. Imagine you need to borrow money from a friend. The interest you give your friend for lending you the money, that's the repo rate. In the grand scheme of the financial world, the repo rate is the interest rate at which commercial banks borrow funds from the central bank to meet their short-term needs. This rate is crucial as it influences the cost of borrowing for banks. A lower repo rate encourages banks to lend more, stimulating economic activity. On the flip side, a higher repo rate discourages borrowing, promoting savings, and helping to control inflation. Now, let's flip the scenario. Suppose you have surplus money and you decide to lend it to your friend for a short period. The interest your friend gives you, that's the reverse repo rate. It's the rate at which the central bank borrows money from commercial banks. This rate serves two key purposes: managing excess liquidity to control inflation and providing a risk-free return, fostering stability in the financial system. So, you might be thinking, how do these rates affect me? Well, these rates indirectly influence your personal finances in several ways. They impact loan rates, deposit rates, economic stability, and investment opportunities. For instance, an increase in the repo rate could lead to higher interest rates on your personal loans, and a rise in the reverse repo rate could mean higher returns on your savings. So, in essence, repo and reverse repo rates are like the interest rates in your daily life transactions. While it might seem overwhelming at first, understanding these rates can help you make informed financial decisions. Stay tuned as we delve deeper into the impacts of repo and reverse repo rates in our next segment. Now, you might be wondering, how does the repo rate impact you and me? Well, let's dive into it. The repo rate is like the invisible hand that gently nudges the economic wheel. Its impact on our daily lives might not be immediately apparent, but it's there, subtly influencing our financial decisions. Let's start with the most direct impact: loan rates. When the repo rate increases, banks face higher costs to borrow funds from the central bank. To cover these costs, banks often increase the interest rates on loans they offer to their customers. So if you're planning to buy a house, a car, or even take out a personal loan, a higher repo rate could mean that you'll be paying more in interest. That dream house or car suddenly becomes a bit more expensive. But it's not all gloom and doom. The repo rate also plays a vital role in managing the economy. When the repo rate is high, borrowing becomes more expensive. This discourages excessive borrowing and spending, which can help control inflation, that pesky phenomenon that erodes the value of your hard-earned money. On the flip side, when the repo rate is low, it encourages borrowing. This stimulates economic activity as businesses are more likely to take loans to expand their operations, and individuals find it cheaper to finance big-ticket purchases. This can lead to job creation and boost overall economic growth. However, remember that while a low repo rate can stimulate the economy, it might also lead to inflation if not carefully managed. It's a delicate balancing act that central banks around the world grapple with every day. So whether you're a borrower or a saver, the repo rate has an impact on you. It influences the cost of borrowing, the return on your savings, and even the health of the economy you live in. Understanding the repo rate can help you make better financial decisions and even predict economic trends to some extent. So a higher repo rate might make that dream car a little more expensive. But by keeping an eye on the repo rate, you can plan your finances better and make that dream a reality. On the other hand, how does the reverse repo rate come into play? Well, the reverse repo rate is the interest rate that the central bank pays when it borrows money from commercial banks. It's like the interest you would give to a friend if they lend you money. But why would the central bank need to borrow money, you may ask? When commercial banks have excess funds, the central bank steps in to absorb this excess liquidity. By doing so, the central bank is essentially preventing banks from lending out too much money, which could lead to inflation. This is an important aspect of managing the economy's overall health. Now let's look at how changes in the reverse repo rate can affect deposit rates. When the central bank increases the reverse repo rate, banks may be incentivized to lend more to the central bank rather than offering loans to individuals or businesses. Consequently, banks might increase the interest rates on savings accounts and fixed deposits to attract more funds. So, if the reverse repo rate goes up, you might see a higher return on your savings account or fixed deposit. Furthermore, the reverse repo rate offers a risk-free return to commercial banks. It provides them with a safe and secure way to earn a return on their excess funds. This practice contributes to the stability of the financial system by ensuring banks always have a safe place to park their excess funds. In short, the reverse repo rate plays a crucial role in maintaining economic stability and controlling inflation. It also influences the amount of interest you earn from your savings account or fixed deposit. An increase in the reverse repo rate could mean that your bank will offer higher interest rates on your deposits, incentivizing you to save more. So, a higher reverse repo rate could mean your savings account works a little harder for you. But it's not just about your loans or deposits, it's about the bigger picture. When we talk about the bigger picture, we're referring to the overall economic landscape that these rates help shape. Stable repo and reverse repo rates foster a stable financial system, which is crucial for economic growth and stability. You see, when these rates are stable, it creates a predictable environment for planning finances and making investments. It's like knowing the weather forecast before planning a picnic. You wouldn't want to pack your basket only to be caught in a downpour, would you? Similarly, knowing the financial forecast helps you plan accordingly, whether you're thinking of taking out a loan, saving, or investing. Let's talk about inflation and interest rates. When these rates are stable, it can lead to lower inflation. Why is this important? Well, high inflation can erode the purchasing power of your money. It's like going to the market with 100 rupees and coming back with less than what you could have bought last year with the same amount. Lower inflation helps preserve the value of your money. Interest rates. Lower interest rates can stimulate economic activity by making borrowing cheaper. This encourages businesses to invest and expand, leading to job creation and increased consumer spending. On the flip side, higher interest rates can discourage borrowing and encourage saving, which helps control inflation. But what about investment opportunities? These rates can influence where individuals choose to put their money. Rising repo rates can discourage investment in riskier asset classes like stocks and bonds, as individuals might prefer to save money in risk-free instruments like fixed deposits. Conversely, falling repo rates might encourage investors to seek higher returns in the market. So, whether you're a borrower, a saver, or an investor, these rates do affect you. They shape the economic landscape, influencing your financial decisions in more ways than one. Understanding their implications can help you navigate the financial world with more confidence and make informed decisions that align with your personal goals and financial situation. So, whether you're a borrower, a saver, or an investor, these rates do affect you. Now that you have a better understanding of these crucial financial terms, what's next? Well, let's recap the key takeaways from today's discussion. We started by demystifying two pivotal terms in finance: repo rate and reverse repo rate. Remember, the repo rate is the interest rate at which commercial banks borrow from the central bank, and it plays a significant role in stimulating or controlling economic activity. On the other hand, the reverse repo rate is the interest rate at which the central bank borrows from commercial banks. This rate helps manage excess liquidity and provides a risk-free return to banks on their surplus funds. Then, we delved into how these rates impact you, from loan rates and deposit rates to economic stability and investment opportunities. Repo and reverse repo rates indirectly influence several aspects of your personal finances. For instance, an increase in the repo rate may lead to higher loan interest rates, while a rise in the reverse repo rate could result in better returns on your savings or fixed deposits. We also highlighted the importance of understanding the bigger picture. Stable repo and reverse repo rates foster a predictable financial environment, enabling you to plan your finances and make investments more effectively. As you navigate the labyrinth of personal finance, understanding these rates and their implications can be your guiding light. It's not just about comprehending the here and now, but also about anticipating future trends and making informed decisions that align with your financial goals and situation. In this complex world of finance, staying informed is your strongest asset. It allows you to take charge of your finances, seize opportunities, and mitigate risks. So keep an eye on the repo and reverse repo rates, understand their potential impact, and plan your finances accordingly. And as you continue this journey of financial enlightenment, remember, you're not alone. We're here to help you understand the ins and outs of finance, decode complex terms, and make informed decisions. Don't forget to subscribe to our channel for more insightful financial content. Remember, knowledge is power, especially when it comes to your finances.